Picture this. You wake up, check your phone, and there's money in your account. You didn't work for it, didn't sell anything, didn't even get out of bed. That's the power of dividend investing, the smartest psychological trick in finance that separates wealthy people from everyone else. When you buy stock in a company, you own a tiny piece of that business. When that business makes profit, they share some of it with you. That's a dividend. It's not charity. You earned it by being an owner. Apple pays shareholders 96 cents per share every quarter. Own 100 shares, get $96. Own 1,000 shares, get $960. Own 10,000 shares, get $9,600 every 3 months. The psychology is simple. Growth companies say, trust us, we'll make you rich someday. Dividend companies say, here's cash today, and we'll try to give you more next quarter. Microsoft pays $2.68 per share annually. That's real money hitting your account 4 times per year. Johnson & Johnson pays $4.24 per share. Coca-Cola pays $1.84 per share. These aren't promises. These are cash payments to your brokerage account. Dividend yield tells you how much bang you get for your buck. Simple math? Stock costs $100, pays $4 annually in dividends. 4 divided by 100 equals 4% yield. Coca-Cola yields 3%. Boring, but sustainable. They've increased dividends for 61 years straight through every recession, war, and crisis. Realty income yields 4.5% and pays dividends monthly. They own commercial real estate and collect rent from Walgreens, Dollar General, and FedEx. Steady tenants, steady dividends. High yield often means high risk. Smart investors want sustainable yields between 2 and 5% from healthy companies with growing cash flow. The sweet spot is companies yielding 3 to 4% with 10 to 15% annual dividend growth. Your yield on cost compounds fast when dividends keep increasing. Timing is everything with dividends. Companies announce 4 critical dates. Declaration date, when they announce the dividend amount. Record date, when you must be on the company's books as a shareholder. Excluding dividend date, the cut-off day. Payment date, when money hits your account. Miss the excluding dividend date by 1 day, get nothing. Here's what happens. Stock trading at $100 pays $2 dividend. On excluding dividend date, stock opens at $98. The market adjusts because the company just gave away money to shareholders. Day traders try to game this system. Buy before excluding dividend date, collect dividend, sell after. But transaction costs, taxes, and bid-ask spreads usually kill any profit. The excluding dividend date is typically 2 business days before the record date. So if the record date is Friday, excluding dividend date is Wednesday. Buy Tuesday, get dividend. Buy Wednesday, miss it completely. Settlement takes 2 days, so buying on excluding dividend date means you won't officially own the shares until after the record date. Dividend aristocrats. These are the royalty of dividend stocks. Dividend aristocrats have increased their dividend payments for 25 straight years. Through recessions, crashes, pandemics, wars, inflation, deflation, everything. There are only 65 companies in this exclusive club. Coca-Cola, Johnson & Johnson, Walmart, McDonald's, Procter & Gamble, Colgate-Palmolive. These aren't exciting tech startups promising to change the world. They're boring businesses selling products people need, regardless of economic conditions. Coca-Cola has increased dividends for 61 consecutive years. Started paying 8 cents per share in 1963, now pays $1.84. That's 23 times higher. Even during the 2008 financial crisis, when banks were collapsing and unemployment hit 10%, Coca-Cola raised their dividend. People still bought Coke during the worst recession in decades. McDonald's increased dividends for 46 straight years. Doesn't matter if the economy crashes, people still eat fast food. Maybe they eat more fast food because it's cheap. Why do these companies maintain their streaks? Because once you're an aristocrat, Cutting dividends destroys your reputation. Stock price crashes. Institutional investors flee. Management gets fired. These companies will borrow money, sell assets, cut expenses, fire employees, anything to avoid cutting the dividend. Their reputation depends on it. The Dividend Aristocrats Index has outperformed the S&P 500 over the past 15 years with lower volatility, better returns with less stress. Dividend reinvestment. This is where compound growth becomes powerful. Instead of taking cash, automatically reinvest dividends to buy more shares. Most brokers offer this for free. Start with 100 shares of a stock, paying 4% annually. After year 1, buy 4 more shares. Now, you own 104 shares, generating more dividends. In year 2, 104 shares generate enough dividends to buy 4.1 more shares. Now, you own 108.1 shares. After 10 years, you own 148 shares from reinvestment alone. After 30 years, you own over 300 shares. Those 300 shares generate 3 times the dividend income from your original investment, plus the dividends keep growing if the company increases payments annually. Many companies offer direct stock purchase plans with automatic reinvestment. Johnson & Johnson, Coca-Cola, Procter & Gamble all offer these programs. The psychology is beautiful. You invest once, then forget about it. The dividends compound automatically while you focus on your career and life. Dividend versus growth stocks. This reveals your investment psychology and life stage. Dividend stocks are the tortoise. Slow, steady, predictable income. Perfect for people who want to sleep well at night and see money flowing into their accounts quarterly. Growth stocks are the hare. Explosive potential but volatile. Tesla gained 1,000% in 2 years, then crashed 60%. Amazon went from $10 to $3,000 over 20 years, but never paid a dividend. Young investors often prefer growth. They have 30 to 40 years until retirement, plenty of time to recover from crashes. A 25-year-old can handle watching their Tesla stock swing 50% up and down. Older investors prefer dividends for steady income. A 65-year-old retiree needs predictable cash flow to pay bills, not wild price swings. But here's the secret most people miss. Dividend stocks often outperform growth stocks long-term with much lower stress. The S&P 500 Dividend Aristocrats Index returned 11.7% annually over the past 15 years. The regular S&P 500 returned 10.5%. Better returns with companies that actually pay you to own them. Dividends force companies to be disciplined with capital allocation. They can't waste money on crazy acquisitions or experimental projects because shareholders expect their quarterly payments. Tax implications. Dividends create tax consequences most people ignore until April 15th hits them like a truck. Qualified dividends from US companies get preferential tax treatment. Taxed at capital gains rates. 0% for low income, 15% for middle income, 20% for high income. Non-qualified dividends get taxed as ordinary income. Could be anywhere from 10 to 37% depending on your tax bracket. The difference between 15% and 37% tax rates is massive over decades of dividend investing. Real estate investment trusts pay non-qualified dividends taxed as ordinary income. Foreign companies might pay non-qualified dividends depending on tax treaties. This is why holding dividend stocks in tax-advantaged accounts is powerful. Traditional IRAs and 401ks let dividends grow tax-deferred until retirement. Roth IRAs let dividends grow completely tax-free forever. If you're in the 22% tax bracket, every $1,000 of dividends costs you $220 in taxes. In a Roth IRA, you keep the full $1,000. Over 30 years of investing, tax-free compounding creates massive wealth differences. The same dividend portfolio could be worth twice as much in a Roth IRA versus a taxable account. Dividend red flags. High yields trigger psychological greed that destroys portfolios. See a stock yielding 10%, your brain screams, buy now. But high yields usually signal danger ahead. Sears yielded 15% before going bankrupt. Investors chasing that yield lost everything. The high yield was the stock price collapsing, not generous management. Warning signs include yields above 8%, declining revenue for multiple years, debt-to-equity ratios above 50%, and payout ratios over 100%. Payout ratio shows what percentage of earnings goes to dividends. Above 100% means they're paying more in dividends than they earn. Completely unsustainable. Intel's payout ratio hit 150% in 2022. They were borrowing money to pay dividends while losing market share to competitors. Classic dividend trap. Sustainable dividend companies have payout ratios between 40 and 70%. Leaves room for dividend growth during good times and maintains payments during recessions. Free cash flow payout ratio is even more important. Companies can manipulate earnings, but cash flow is harder to fake. Building your portfolio. Diversification prevents dividend disasters that wipe out years of progress. Don't put everything in one high-yielding utility stock or REIT. Spread across sectors: consumer staples, healthcare, utilities, real estate investment trusts, industrials, technology. Each sector behaves differently during economic cycles. Utilities stay stable during recessions because people always need electricity. Banks suffer during credit crunches but recover quickly when rates rise. Consumer staples remain steady because people always need food, soap, and toothpaste. Geographic diversification matters too. Consider international dividend stocks or funds. Different countries have different economic cycles, and currency movements can boost returns. Start with dividend-focused ETFs if individual stock research feels overwhelming. YOM holds over 400 dividend stocks with a 2.8% yield. SCHD focuses on quality dividend growers yielding 3.5%. DVY targets high-yield dividend stocks yielding 4%. Target total portfolio yield between 3 and 4%. Higher yields often mean higher risk or unsustainable payouts. Lower yields might not beat inflation over time. The ideal dividend portfolio combines current income with future growth. Some high-quality companies yielding 2 to 3% but growing dividends 10% annually. Some mature companies yielding 4 to 5% with steady single-digit growth. Balance growth and income based on your age and needs. Younger investors can focus more on dividend growth. Older investors need higher current income. The psychology of dividend investing is building a system that pays you whether markets go up, down, or sideways. Most people chase quick gains and end up broke. Dividend investors build wealth that compounds for decades while generating increasing income streams. While everyone gambles on meme stocks and crypto, you collect checks from companies that have paid dividends since before your grandparents were born.